understand the difference between order blocks and POI. So for a basic start, we have to understand that order blocks and POIs, or OBs and POIs, are not the same thing. So I'm going to start to explain to you what the difference are. Order blocks are known as orders of supply and demand. That is, they are supply and demands where orders are placed into the market. Whereas POI are areas of interest where order flow was made. You have to understand this. Order flow was made in a point of interest, POI or AOI, that is area of interest. Whereas order block are supplies and demands. These two are different. A lot of people confuse these two. I know we get a lot of talks about terminology and stuff like that, but you have to get this thing. It's very crucial. POI is different from order blocks, and the fact the two are different does not mean they don't work. POIs, price might come to your POI and not tap your order block, and price might come to your POI and exceed to your order block, either a supply or a demand. So these two are very crucial to understand when it comes to the concept of spotting the right order block. An example of that, in this diagram you can see here, we have this as our POI. This whole level is a POI. You can see this whole level is a POI. Then this is a supply. This is our order block. I think I should do something here. This is our order block. This is our POI. You might see price come to your POI and drop, or if the price it's not yet at a discount price, it can exceed to your order block before it drops. So it's very important to know this, because as we are going deep into this core video or this video, you're going to see a lot of scenarios where this might be important to get. All right, now we've understand the difference between supply, order blocks, demands, and POIs. Let's now dive into how to spot the right order block. A lot of traders have been taught to identify a valid order block. You need a buy to sell candle or a sell to buy candle, and you should have imbalance, and also you should break a structure. Now this is not wrong, but there is a little thing that is missing, or I would say there is a missing piece to this concept. The missing piece to this concept is institutions have to buy. They have to buy the retailer's stop loss to sell, and they have to sell the retailer's stop loss to buy. That is why the buy to sell candle concept works. That is why the buy to sell concept of order block works. It's very, very important to understand that. So it's not recommended to take a candle, a buy to sell candle, like in the buy to sell candle, to identify the last bullish buy to sell candle as a valid order block, or the last bearish buy to sell candle as a order block. Why? Because most times, not often, most times, they are not the particular candle that broke structure. That is why sometimes you have your order and price doesn't come back to that your order block, but it comes close but don't tap your order block. So let me explain this in a better way for you to understand. Like you can see in this candle, we have a buy to sell candle, and normal order block concepts will tell you to buy. This is your order block, which I never said is wrong. But to me, if you ask me which of this is my order block, I will tell you this is my order block. Some will say this is your refined order block. Now, why will I choose this as my refined order block? Because this was the candle that took out every liquidity here. This was the candle that identified that institutions have taken out every buy stop loss around here before dropping down, which is the concept you can see here. They take out everybody's buy stop loss before dropping down. The same scenario occurs here. Whether it's 3 candles, whether it's 4 candles, this was taken out here. This was the evidence that institutions have swept this place. swept below. So my fine order block should be here. Not minding the imbalance. Even if price wants to fill, no problem. But this is where institution added money into the market or imputed money into the market. The same thing here. This is where institutions imputed money into the market. Now there is another story to this. The candle can vary. If in another scenario we have this like this should be now my valid order block. The color does not matter. The candle color does not matter in any of these scenarios. This now is my valid order block in this scenario. This was where institutions put money in the market. You can see they swept liquidity before dropping to the downside. This will be my valid order block in co-influence with my imbalance. Now, if in a scenario this candle was not here, let's hide this, and we had something like this, sorry, sec. All right, and we had something like this. This is a valid order block to some people, but to me it's not a valid order block. It's only going to be a valid order block if this took out this. This would have been my valid order block. I might decide to use just the wicks. You get? I might decide to use, just the wicks of the candle, which is here, to identify as a valid order block, because you can see here they swept liquidity here too. And see here liquidity was swept here, so it's a valid order block. But if you don't want to refine it to that level, you can choose to use this. Now, if you have a scenario where this is not the case, let's say we have this to be the case, which they've already taught. Almost everyone has taught us this. This is the buy to sell candle. This is a valid order block, but I'm never going to stake my money on this particular order block. Why? Because there is no liquidity to indicate that institution were the one that puts in order in this market. I have to see something like this to indicate that institutions have put in money into the market. Then once I see this, I have an imbalance. Then I'm convinced that, okay, institutions are the ones showing themselves in the market. If you are enjoying this content, I really appreciate if you subscribe, turn in your notification bell, because I'll be dropping another content where I'll be talking in depth about order flow, how institutions actually work in the market. And I will really appreciate if you like this content. It will motivate me to do more on this particular channel. Thank you. So back to what I was saying. This is institutional order. They are the only ones that often take out liquidity to move to the other side. They are the only ones that does that. So it's very important for us to know that if you don't spot a valid sweep of liquidity before an order flow is being placed in the market, avoid that order block. That order block might not be valid. Now we understand the concept of order block, the basic concept of order block. Now let's dive into a restructural scenario in the market. You can see here, institutions did what? They created a buy side liquidity, came down, took out that liquidity, then they showed their footprint in the market. After showing their footprint, they created a little buy to the upside. Then continue to the downside. So we might assume this to be our chalk and this as our BOS. Depend on you. We are not talking about structure in this video. This might be your BOS, this might be your chalk, depend on what scenario you're looking at the markets. Now after that, this whole place where institution did their magic is what we call a point of interest. It's very important to notice that, or it's very important to note that this whole place where institutions moved the money in the market is called point of interest. Now some people might want to do something like this, which is where you hear the, is it QMO, something like that. This becomes their QMO. I think I should just give you an example of that. This becomes a QMO or QM, something like that, which a lot of people talk about. I don't trade that concept, but this is where that concept comes in. So it's very, very important to know how POI and other block works. Now once they spot their QMO or their point of interest, they wait for lower time frame confirmation to take it sell. The same scenario here, you can see price took out liquidity, came down. This was where institution took out buy side liquidity, came down, broke a structure. Then this whole place now, from here where the action took place, from here where the action took place is called our POI. But those that trade QMO or something like that, so I don't make mistake about it, please forgive me if I'm mispronouncing it. This will be where they take their order, which you guys know about, then they take it so it's a simple concept you will learn if you understand how POI, or if you understand how POI and other block works. So once again, if you're enjoying this content, I really appreciate if you like this content, follow or subscribe, follow my other links and subscribe. I really appreciate that. Now back to the content again. Now this is a scenario, a diagram scenario of how the concept works, and if you want I can turn it upside down. The same thing in the sell scenario, same thing in the sell scenario. You can see this is your inducement set. Now this is your BOS, set. Same thing here. This is your BOS, this is your inducement. Alright, so in this scenario, obviously you know the QMO will be this, obviously. Then in this other scenario, the QMO will be this. So that's how the concept works. If you understand how POI and other block works, you understand how the concept of QMO, whatever they call it, works. Now I hope with this content you're able to understand everything in an easier way